Hello everyone and welcome into the channel. My name is Brent, and in today's video we are going to be checking out the Roth IRA over on M1 Finance. We're going to go ahead and hit up 4 areas today. Number 1, we're going to be taking a look at the overall portfolio performance of the M1 Finance account. Number 2, we're going to go into the weekly performance over the past week in comparison to the main indexes. We're going to go ahead and take a look at what positions in our portfolio, which ones were good, which ones were bad, and take a look at how they did in comparison to, say, the S&P 500, the Dow Jones, and the NASDAQ. Then we're going to go ahead and take a look at the entire S&P 500 performance for the past week, see if there was any specific areas in the market. While it was pretty green, showed any signs of weakness. Some of the pattern has been repeating, right? We try to break out sooner. We'll go over that pattern here in a little bit. Number 3, we're going to hit up the activity over the past week. What did we buy? What did we sell? And what dividends came in within the portfolio. And then finally, number 4, we're going to go ahead and cover the updated dividend performance, or the updated dividend income of the M1 Finance dividend portfolio. This thing recently broke over $1,200 within the last month, and it's just continuing to scale and grow from there. So we're going to go ahead and cover that as number 4. So let me know down in the comment section below if you guys have any comments or questions for me. Let me know what stocks you guys are currently looking out and potentially buying, and what do you think is going on with the market right now? Are you guys still kind of optimistic? Maybe you guys are optimistic that it will recover, or maybe not as optimistic and kind of like, this is a little the big fake out that it'll kind of pop up but eventually kind of fizzles out. So let me know down in the comment section below. And of course, with that, if you guys are brand new here to the channel, have not yet subscribed, go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time we release a brand new video by selecting the all notifications. And let's go ahead and get into the video. So we're going to start over on number 1, the Roth IRA over on M1 Finance, taking a look at the overall performance of the portfolio. Right now, this actually has been doing fairly well. I've seen a lot of other portfolios out there, similar time invested over within the portfolio. This account was started back on January 8th, 2018. I started it at $0, and this is a Roth IRA. So you have a cap of $6,000, or at the time when I started this was $5,500 that you can contribute to the account per year. That is it. You can't over contribute. It's set at specifics, and then the following years the maximum was increased to $6,000 per year. So that is what we've been investing in this account over the past few years. Right now, the portfolio overall sits up 50.67%, and at highs we were up 77% or so. So we have pulled back slightly, but overall we're still market gains of positive, and the earned dividends there have continued to roll in. Those never go away. They are dividends that we have earned, been paid out, and have been reinvested back into the portfolio, buying back more shares, essentially with money that, where it was given to us, right, through dividends. So overall, let's go ahead and take a look at the overall performance and which ones are our main winners. The number 1 winner here up at the top is Apple, very nicely up 217%. AbbVie has been kind of mixing in between, AbbVie, Pfizer, and ABM Industries. These 3 positions have been really kind of bouncing around within the last few weeks and months. We have Cisco Corp. This one, not too long ago, I remember that Cisco Corp did move down. I don't know if it was in the green, but it had got beat up or if it was in the red, but I do remember it had got beat up pretty nicely. And at that time when it got beat up, we deposited more money into it. It seems like it's gone pretty nicely here. It's up in 5th place as far as the positive positions, and then it kind of trails down from there all the way down, from triple digits into double digits, all the way down to our worst performing companies. Right now, Clorox has been and remains to be the worst position in our portfolio, but it is off its lows. At a low it was down, this shows say 41%. It's not really down 41%. We invested about $2,000 into it. It's about 1/4% or 1/4 of its value down, about 25% in total down. The percentage here is kind of off for some reason, so it's pretty interesting. I don't know why there. We have Innovative Properties. This one really took a nosedive here within the last few months, going from pretty positive green. We can actually click into here and see the performance here. We can see here that at a time, how much money did we have invested? We had put roughly 1961 into it. At a high, it had nearly broke to $3,000. And here we are, just, June 26th here. It has essentially lost all of its value and then some, down 34% overall. So it has had some very high swings here. And that's just because I believe that rates are kind of going up. It becomes more expensive to hold debt. This is within the MJ industry. So it has other complications with it, with maybe loans and debt becoming more expensive. The industry that it's in is maybe a little bit, slower at the moment. So it has taken a bit of a beating. Stanley Black & Decker, high inflation, prices are going up. People are kind of coming back and spending less money on products that they may not need. So Stanley Black & Decker being a very specific brand for specific products, probably not one that a lot of individuals are going out there and buying, purchasing, just kind of having to, go out and miscellaneously buy. So this one has taken a bit of a beating, down nearly 20% there in the portfolio. Starbucks here and Waste Management are my better of the negatives right now, but these are brand new positions that we just added here in 2022. So both Starbucks and Waste Management were positions that we recently started here, and we bought them when they were already getting beat up. We don't know where the bottom was at, but they were so beat up in the time frame that we bought them that it didn't make sense to not continue to buy them as they were trailing down, because they dropped down to a percentage, or I don't know if I can see the yield on these right now. But the yield on Starbucks right here, it does not show. Oh yeah, right there, 2.44% dividend yield on Starbucks. So that's a very high yield for Starbucks, kind of starting off. Generally, if you had bought it in the past, you wouldn't get anything over 2%. Right now, they're getting about 2.5%, and they had been beat up quite a bit. I'm not going to try and time the bottom. They're a great business. Out of a lot of the coffee businesses that are out there, they're one of the most known for their products and their service, and they offer quite a bit of their apps that many people deposit money into. So they have a lot of other little tech-based little things that kind of help them as well. Waste Management is another company that I bought here in 2022. This one again has a 1.62% yield. May not seem high overall in comparison to, say, Starbucks or other REITs, but in its own industry and in its own area, it's actually pretty decent for the current time being. So again, I didn't know where the bottom was at, but I wanted to move into these positions because they seem like a great buying opportunity. And while I didn't know where the bottom was at, it was just fine kind of buying them and continue to buy them on the way down, because eventually when they do recover over time, they will move higher. So that is number one, the overall performance of the portfolio. I think we're doing really good through what is currently going on in the market. I've seen a lot of portfolios out there once again being very red, but here we are on a weekly basis continuing to chug along, buying the dip, continuing to dollar cost average, not getting all antsy about our portfolio and selling out of positions, buying into random positions. We're sticking with what this portfolio was made for and to do, so which was a dividend portfolio, invested in dividend companies. So here we are. We're going to go ahead and jump into number two, the weekly performance of the portfolio. Now, the weekly performance here, we had a massive gain here this past week. Last week, we had a pretty big hit. We lost 4% last week. That was the biggest loss in a single week that this portfolio has actually had. In comparison to the other indexes, we were only down off our our highs. This portfolio was down roughly about 15% off its highs. That's when I extracted the amount that I had funded this year. So we're actually off our highs a little bit less than that. And then this past week here alone, we're up 7.37% here. If we compare that to the main indexes, the S&P 500 put on 6.45%. The Dow Jones put on 5.39%. The NASDAQ here put on 7.49%. And the Russell put on 6.01%. So overall, our portfolio actually exceeded all of the other indexes here, 5.49. Yeah, besides the NASDAQ. But the NASDAQ had taken such a harder hit than us. It just kind of makes sense for that to happen. So overall, when taking a look at the M1 Finance portfolio, weekly performance in comparison to the index, I'm pretty pumped that we are gaining like a 7.37% gain. That's nearly $3,000 in market gains. We can see here we clearly blasted back over where we were just at last week. You know, we got hit pretty hard last week. Our portfolio went nearly $4,000 into the negative between a 3-week period, and then here we are in a single week, kind of coming back very sharply here. We gained $3,000 right back, and we can see here a lot of this comes back from Clorox. Hey, guess who it was? Clorox in the back. That is our worst position in the portfolio, but it has been beat up so much that maybe investors are looking to it as, you know, a potential buy in this current market. ABM Industries, this is a position that moved up into second place overall. But even while it's only in second place, or even though that's in second place overall in performance, on a weekly scale, it is still gaining a very nice amount here, up 13.28%. Pfizer up 10.87%, AbbVie up 10.17%, and then IIPR. Hey, this could be a good opportunity. I could have maybe potentially averaged into IIPR. That could be something I could consider. I think they're going up on ex-dividend here in the future. So if I go over to Seeking Alpha, IIPR, and go ahead and select them. I don't know if I have them actually thrown into this portfolio. Oh, I do. They go ex-dividend on 6/29. Wow, hey, that is on Wednesday. So this could actually be a pretty good opportunity for me to both average down on a position that I own that is in the negative, that is showing signs of recovery with a pretty decent yield. I think they have like a 5.10% starting yield on IIPR. I don't recommend people, if you guys haven't already looked into it, it has a pretty high payout ratio, but this is a REIT within the MJ industry. When I had taken a look at this company a while back, it seemed like in a company that I wouldn't mind taking a little bit of risk buying into. And, you know, so far it had been doing really well in the short term, you know, in the past before the whole dip, but it has been beat up here in recent times. Merck here, Digital Realty Trust, and then it kind of just trails on. We didn't actually have a single negative position in our portfolio this week. So I don't remember the last time we didn't have any red in the portfolio. So that is very weird. I was going down here expecting to see a little bit of red. Not a single stock in our portfolio was red this week. So that is the weekly performance. We had some overall, everything was green. Clorox seems to be bouncing up along with IIPR, which is some of the more beat up positions, along with Starbucks, up 8.68%. And Waste Management here was up 6.75%. So overall, a lot of the positions were very positive. Besides the 1 week performance, we can see here, if you guys are taking a look at the S&P 500 on the 1 week performance really quickly, again, we had a lot of positions that were green. Every single position in our portfolio was green, but you can clearly see here, where is the red right now? Energy. Energy had been and still is at near all-time highs. That is the best performing sector of the market here in 2022. If we look at, you know, everything here looks amazing. Amazon up 12.35%, Tesla 15.3%, Google, Microsoft, Apple, you know, everything across the board is essentially positive. Besides Altria. Altria came out, they're banning Juul. That was an acquisition I believe they did a couple years ago. This one didn't do so well last week. Still continues to go down this week. But if we take a look at the S&P 500 and go over the year-to-date performance, we can see here energy up. Exxon 42.02%, still Chevron 23.37. We have ConocoPhillips 26.32. And the list just kind of goes on. But you can see here, visually, year to date, where have been the best sectors to, you know, have diversity. Healthcare with Johnson & Johnson, Eli Lilly, Avi, Merck. And then we had oil and gas. Oil and gas has been the sector that, if you have oil and gas in your portfolio, you may have not taken much. You probably still would have taken a big hit because nobody has a lot of oil and gas in their portfolio. A lot of portfolios out there are pretty invested in technology. My dividend portfolio is actually very little invested in technology outside of, say, Apple. Let's go ahead and take a quick look through here and see, do any companies here really stand out as being tech-based? So we have Apple, we have Cisco, we have yeah, that's basically it. My two tech companies are Apple and Cisco. One makes devices and provides services. The other one creates devices. They also provide services as well. Probably not as common to say Apple as far as use or along those lines. Now, jumping into number 3, what is our activity over the past week? Well, last week we had the 20th through the 24th. So we can see here that on the 21st, we had Stanley Black & Decker pay out $4.52. And we had Lockheed Martin paying out $14.46. So $4.52 plus $14.46 is $18.98. Plus we deposited that amount there of $127.66. And that should get our grand total to invest here on Monday of $146.64, which looks about right. So if I go back over here, yeah, $146.64 on the dot. We also bought 2 companies last week. So if you guys tuned in, I think we did go over what we had purchased. We did end up buying JP Morgan. It was in the negative at the time. It had actually gone down below where we initially had purchased that company. So it showed signs of, hey, we should buy this company right now. It's in the red. It hasn't been in the red in quite a while. And then once you know it, here this week, it moved up 7.14%. Oh, it's actually, yeah, it moved up more than that and put it into the green. A pretty decent amount right there. Waste Management still in the negative right there. So I'm pretty pumped here to buy. Like some companies that I'm really looking at right now are JP Morgan, Waste Management. JP Morgan did pop up a little bit over my the threshold to become green again. So Waste Management is still a position that I'm pretty interested in adding more equity into. Also IIPR, this could be one that just kind of split it in half, say Waste Management and IIPR. I don't mind putting a little bit of equity towards either of those. So that is the activity over the past week. Now, because we did buy 2 companies, we bought JP Morgan as Waste Management. That goes into our final area, number 4. What is the portfolio's current dividend income? Now, again, we did buy JP Morgan last week. So here we increased our share count on JP Morgan. We now hold 13.73 shares of JP Morgan. So I can go over here and increase my thing. Essentially, we go from, let's go ahead and take do I have a notepad anywhere? Okay, so I pulled up my notepad. Our yield is 2.92. Our yield on cost is 3.22%. Our annual income is $1,209. And our portfolio beta is 0.69. So if we go ahead and adjust JP Morgan, which currently sits at, it pays out $49.61 per year in annual dividends here. And this is actually going to increase here now because we're going to increase the share count to now 13.73. And our unit cost is $119.45. So here we actually lowered our cost basis to $119.45. And we can see here that JP Morgan went from $49.61 of annual pay to now $54.92 of annual pay. So that is a very nice little bump right there. The other position that we purchased last week was Waste Management, which is located right there. Waste Management is now 11.9 shares of Waste Management with a cost basis of $157.86. Let's go ahead and punch that in my calculator there. And we can go ahead and head over here to Waste Management. Right there, we can see here we had 10.82 shares. So we actually increased our share count to 11.9, which is we purchased an additional share. So that'll be pretty nice. And our cost basis here went from $159.41 to $157.86. So that's actually a pretty nice dip there in the cost basis overall. And I didn't see what the dividend amount was prior, but we're at $30.94. If we head back up to the top, we're still at a portfolio yield of roughly 2.92. Our yield on cost went down by 0.01% from 3.22 to 3.21%. But our annual income here increased from $1,209 to $1,217. So we just increased our annual income. We basically gave ourselves a raise of roughly $8 by investing last week alone. So again, if you guys invest on a weekly basis, right? If you guys are adding $8 per week to your annual income, 8 times 52, it may not seem like a lot right now, but if you do this on a yearly basis, you are increasing your income by $416. This is just this week. This is just an example, right? This year, you're increasing your annual income by $416. Next year, you're increasing it, say, another by $416. Now you've increased your annual income over the past 2 years by $832. But this begins to compound in itself. It's not always going to be exactly $416, right? These are going to continuously compound and compound because you're taking the amount of annual income that you're getting paid to you. And while my portfolio has a cap per year of $6,000 that I can contribute, the annual income that it generates is able to rebuy back more shares on that weekly basis, on that quarterly basis, which increases the next quarter's annual dividend payouts, and just continues to compound month after month, year after year. And soon, the annual income in this portfolio, say over the next 4 years, should be hitting roughly $3,000 to $4,000. So already within the account, within the next couple years, will already be generating half of what I can, generally deposit into the account itself. So I'm pretty excited to kind of see where this portfolio heads to in the next few years. But that is going to be it for this weekly recap. If you guys enjoyed the video, definitely go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time I release a brand new video, and of course, give this video a thumbs up, make it blue. I highly appreciate it if you leave me a comment down below. If you guys have any comments or questions for me, let me know there as well, and let me know what you guys are doing in the market. I know we had kind of talked about this a little bit here at the beginning. Overall, the trend year to date, right? We started at highs, we dipped, had a lower bottom on the double dip, lower double bottom, try to break back out, move back to all-time highs, didn't quite make it, fizzled out, dropped to a bottom, double bottom here with a slightly, on par double bottom, try to break out at those same records here, didn't quite break out, and it returned here. Here we are again, repeating the same instance here. We hit that double bottom, lower double bottom. We try to break out, see, similar pattern here. We try to break out, didn't break out, fell back to, and here we are in that second double bottom. Oh, this is actually here. We can actually see here, this is double bottom right here. False breakout, falls, and then tries to, but doesn't quite, make it, fizzles out. There's a double bottom there, and then here we are in the third pattern here. We have a double bottom here, try to break, didn't quite make it, fizzled out here, try to break out, didn't quite make it. There's a lot of resistance here at 405 right now, and then we fell to around $360 and some change. I think we fell within 360s. And here we are trying to break out once again. There's a lot of invest. I'm still highly invested. Every single one of my accounts, I never sold anything. I never sold out of anything. I'm still invested over on my Merrill Edge accounts, my 401k, my M1 Finance accounts, Fidelity accounts. Everything is invested. I'm still overall essentially net positive, but it has taken a little bit of a beating here. I think, I don't know what will happen. Looking at the past performance here over the past year, there's a lot of resistance here at 405. There's also still a lot of issues where, we're trying to deal with inflation. And once we actually deal with inflation, we go into a deflation. That's generally not positive for the market versus being an inflationary market. So we will see what time tells, right? I think that's the saying. But that is it for me. Appreciate everyone tuning in today, and I will see you guys in the next video. Bye-bye.